4 times. That's it. In 156 years of U.S. market history, only 4 times has this pattern appeared. It just happened again. And most investors are completely asleep at the wheel right now. Here's what's really going on and what you should be thinking about right now. 156 years of market data, thousands of trading days, countless crashes, rallies, wars, recessions, and this signal has only triggered 4 times. The U.S. stock market is flashing a pattern right now that Motley Fool's analysts are calling a once-in-a-generation technical and fundamental convergence. The previous 3 occurrences? Each one preceded a defining generational market move. We're talking moves that made careers or wiped out portfolios. Here's the gut punch. Investors who recognized those prior signals and positioned correctly didn't just survive, they built lasting wealth. The ones who ignored it? Different story entirely. 3 instances across 156 years. 3 defining moments. Now, right now, we are sitting in the 4th. This isn't noise. This isn't a blip. Historical data is pointing with rare clarity toward what tends to happen next. The question is, are you positioned for it? Wait, before we go further, do you actually know how your portfolio is allocated right now? Because what comes next changes everything about how you should answer that question. But here's what nobody is saying about this yet. The financial media is covering the surface-level market moves, the daily point swings, the Fed headlines, the earnings beats. What they're glossing over is the underlying structural signal buried in 156 years of data. This isn't about this week. This isn't about this quarter. Every single prior instance of this pattern resolved over months, sometimes years, and the investors who acted on short-term panic made the worst decisions of their investing lives. The 4th occurrence of a 156-year pattern doesn't ring a bell on the NYSE floor. It shows up quietly in the data, and then history moves. First, audit your current allocation right now. Compare where you're positioned against historically defensive allocations during the prior 3 occurrences. Overexposure to high beta equities deserves a hard second look. Second, consider whether defensive assets are underweighted in your portfolio. Historically, periods following this type of signal have rewarded investors holding positions in treasuries, dividend-paying equities, and alternative stores of value. Third, if your time horizon is under 10 years, downside hedging strategies deserve serious consideration right now. Protective puts, defined risk positions, or simple cash rebalancing are all worth a conversation with your advisor. 156 years. 4 occurrences. History is rhyming right now, loud and clear. What do you think this means for your portfolio? Drop it below. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.